Hello students, now we are going to discuss the second unit, financial analysis using discounting and non-discounting techniques. In this session, we are going to focus on the accounting rate of return, payback method and NPV method with their merits and demerits with a special focus on its computation. Let's first understand the meaning of discounting and non-discounting techniques. In the evaluation of projects, the investment evaluation techniques play a vital role. The selection of the right kind of project is essential to ensure the wealth maximization of shareholders. Not only this, since projects are committed for long term, it is necessary to make a careful choice. A wide range of criteria has been suggested to judge the worthiness of various projects or financial decisions. These evaluation techniques can be divided into two: traditional techniques or non-discounting techniques and modern techniques or discounted techniques. The traditional techniques are further divided into payback period and accounting rate of return. The discounted cash flow techniques are again subdivided into three: net present value, internal rate of return, profitability index. Now let's understand the first technique, payback period. As the name suggests, this method refers to the period in which the proposal will generate cash to recover the initial investment made. It purely emphasizes on the cash inflows, economic life of the project and the investment made in the project with no consideration to time value of money. Through this method, selection of a proposal is based on the earning capacity of the project. With simple calculations, selection or rejection of the project can be done with results that will help gauge the risk involved. However, as the method is based on thumb rule, it does not consider the importance of time value of money and so the relevant dimensions of profitability. Let's take an example to understand this technique. From the details, you can see that payback period of project B is shorter than A. Let's take one more example. Assume that a project requires an outlay of rupees 50 lakhs and yields annual cash inflow of rupees 12,50,000 for 7 years. What would be the payback period? Using the formula PB is equal to outlay upon cash inflow, we get the answer to be 4 years. In case of unequal cash flows, the payback period can be found out by adding up the cash inflows until the total is equal to the initial cash outlay. Suppose a project requires a cash outlay of rupees 20 lakhs and generates cash inflows of rupees 8 lakh, 7 lakh, 4 lakh and rupees 3 lakh during the next 4 years. What is the project's payback? When we add up the cash inflows, we find that in the first 3 years, rupees 19 lakhs of the original outlay is recovered. In the 4th year, cash inflow generated is rupees 3 lakh and only rupees 1 lakh of the original outlay remains to be recovered. Assuming that the cash inflows occur evenly during the year, the time required to recover rupees 1 lakh will be rupees 1 lakh upon rupees 3 lakh into 12 months, which will give you 4 months. Thus, the payback period is 3 years and 4 months. Now, what is the acceptance rules for this method? Various firms use this technique of evaluating projects. The project's payback is compared with standard payback. The project would be accepted if its payback is less than the standard payback. This technique gives highest ranking to the projects with lower PB and lowest ranking to the projects with high paybacks. This method has certain virtues. First, simplicity. This method is simple to understand and easy to calculate. It is cost effective, requires less time and easy analyzing, which makes it more cost effective. Short-term effects. A company can have more favorable short-run effects on earnings per share by setting up a shorter standard payback period. Risk shields. The risk of the project can be tackled by having a shorter standard payback period, as it may ensure guarantee against loss. Liquidity. The emphasis in payback is on the early recovery of the investment. Thus, it gives an insight into the liquidity of the project. In spite of these virtues, there are certain serious limitations. First, cash flow after payback. Payback does not take into account the cash inflows earned after the payback period. Cash flows for the whole life of the project are not considered. Payback is the method which fails to measure the profitability of an investment project, as it does not consider all the cash inflows of the project after the payback period. Cash flow patterns. Payback fails to consider the pattern of cash inflows, that is, magnitude and timing of cash inflows. In other words, it gives equal weightage to returns of equal amounts even they occur in different time periods. Inconsistent with the shareholder value. Payback is not consistent with the objective of maximizing the market value of the firm's shares. Now, let's understand a better method compared to payback period, that is discounted payback period. In a capital budgeting technique, the project should be evaluated on the basis of overall profitability of a project. In contrast to an NPV analysis, which provides the overall value of a project, a discounted payback period gives the number of years it takes to break even from undertaking the initial expenditure. The payback period only measures how long it takes for the initial cash outflow to be paid back, ignoring the time value of money. Projects that have a negative net present value will not have a discounted payback period because the initial outlay will never be fully repaid. This is in contrast to a payback period where the gross inflow of future cash flows could be greater than the initial outflow, but when the inflows are discounted, the NPV is negative. The discounted payback period is the amount of time that it takes to cover the cost of a project by adding positive discounted cash flow coming from the profits of the project. The advantage of using the discounted payback period over the payback period is that it takes into account time value of money. When using the discounted payback period for decision making, a firm must first determine a discount rate at which to discount the future cash flow values of a specified period of time. The discounted payback period should be in terms of years. If the discounted payback period is less than the predetermined period of time, then the decision rule is to accept the project. On the other hand, if the discounted payback period is greater than the predetermined period, then the decision rule would be to reject the project. Let's see the definition of discounted payback period. Discounted payback period is used to evaluate the time period needed for a project to bring in enough profits to recoup the initial investment. Let's understand with an example the discounted payback period. Mr. A is considering investing in a business. The business will cost rupees 10 lakhs to set up and is expected to generate the following yearly net cash flows. The cost of capital is 10%. Calculate the discounted payback period and comment on your answer. Using the formula for discounted payback period, A minus 1 plus cost minus cumulative present value of cash flow for A minus 1 year divided by present value of cash flows for A year. Substituting the figures, we get the answer as 4.27 years or 4 years 99 days. Now let's understand the other technique, accounting rate of return method. This method helps to overcome the disadvantages of the payback period method. The rate of return is expressed as a percentage of the earnings of the investment in a particular project. It works on the criteria that any project having ARR higher than the minimum rate established by the management will be considered and those below the predetermined rate are rejected. This method takes into account the entire economic life of a project, providing a better means of comparison. It also ensures compensation of expected profitability of projects through the concept of net earnings. However, this method also ignores time value of money and does not consider the length of life of the projects. Also, it is not consistent with the firm's objective of maximizing the market value of shares. Let's understand this method with an example. An initial investment of rupees 13 lakh is expected to generate annual cash inflow of rupees 3,20,000 for 6 years. Depreciation is allowed on the straight line basis. It is estimated that the project will generate scrap value of rupees 1,05,000 at the end of the 6th year. Calculate its accounting rate of return assuming that there are no other expenses on the project. Let's solve it. First, we will calculate annual depreciation, which is equal to initial investment minus scrap value to be divided by useful life of the equipment. Annual depreciation comes to 1,99,167. Then we will calculate average accounting income, which comes to rupees 1,20,830. Then we will apply the formula for accounting rate of return, that is average income to be divided by investment. We get 9.3% as accounting rate of return. Let's take one more example. Compare the following two mutually exclusive projects on the basis of ARR. Cash flows and salvage values are in thousands of rupees. Use the straight line depreciation method. From the details of project A and project B, we can see that cash outflow is given to be 22,000 and for B project it is 19,800. Cash inflows are given, salvage value is given. Now let's see how to calculate it. The first step is to calculate the depreciation by using a formula outflow minus scrap value to be divided by number of years. Therefore, we get 7,000 rupees as depreciation. In the second step, we have to deduct the depreciation to calculate the accounting income. In the third step, we have to calculate average accounting income and finally we have to divide the average accounting income by investment to get ARR. Similarly, for project B, we would repeat the steps. Since the ARR of the project A is higher, it is more favorable than the project B. Now let's discuss the advantages and disadvantages of accounting rate of return. Let's focus on advantages first. Like payback period, this method of investment appraisal is easy to calculate. It recognizes the profitability aspect of investment. But it also suffers from various disadvantages. It ignores time value of money. Suppose if we use ARR to compare two projects having equal initial investments, the project which has higher annual income in the later years of its useful life may rank higher than the one having higher annual income in the beginning years, even if the present value of the income generated by the latter project is higher. It can be calculated in different ways. Thus, there is problem of consistency. It uses accounting income rather than cash flow information. Thus, it is not suitable for projects which having high maintenance cost because their viability also depends upon timely cash inflows. Now, let's focus on discounted cash flow methods. The discounted cash flow technique calculates the cash inflow and outflow through the life of an asset. They are then discounted through a discounting factor. The discounted cash inflows and outflows are then compared. This technique takes into account the interest factor and the return after the payback period. The very important discounted methods is net present value method. This is one of the widely used methods for evaluating capital investment proposals. In this technique, the cash inflow that is expected at different periods of time is discounted at a particular rate. The present values of the cash inflows are compared to the original investment. If the difference between them is positive, then it is accepted or otherwise rejected. This method considers the time value of money and is consistent with the objective of maximizing wealth for shareholders. The operational criteria for wealth maximization is increase in share price. It should be noted that the cost of capital K is assumed to be known, otherwise the net present value cannot be known. NPV is equal to PVB minus PVC, where PVB is equal to present value of benefits and PVC is equal to present value of cost. Net present value of a project is the potential change in an investor's wealth caused by that project while time value of money is being accounted for. It equals the present value of net cash inflows generated by a project less the initial investment on the project. It is one of the most reliable measures used in capital budgeting because it accounts for time value of money by using discounted cash flows in the calculation. Net present value calculations take the various inputs, projected net cash flows in successive periods from the project and a target rate of return, that is the hurdle rate, where net cash flow equals total cash inflow during a period including salvage value if any less cash outflows from the project during the period. Hurdle rate is the rate used to discount the net cash inflows. Weighted average cost of capital WACC is the most commonly used hurdle rate. The net cash flows may be even, that is equal cash flows in different periods, or uneven, that is different cash flows in different periods. When they are even, present value can be easily calculated by using the formula for present value of annuity. However, if they are uneven, we need to calculate the present value of each individual net cash inflow separately. Once we have the total present value of all project cash flows, we subtract the initial investment on the project from the total present value of inflows to arrive at net present value. Thus, we have the two formulas for the calculation of NPV when cash inflows are even. The formula NPV is equal to R into 1 minus 1 plus I within brackets raised to number of years upon I minus initial investment. In the formula, R is the net cash inflow expected to be received in each period. I is the required rate of return per period. N are the number of periods during which the project is expected to operate and generate cash inflows. When cash inflows are uneven, NPV is equal to R1 upon the discounting factor plus R2 upon the discounting factor for second year plus R3 divided by discounting factor for the third year and so on minus initial investment, where I is the target rate of return per period, R1 is the net cash inflow during the first period, R2 is the net cash inflow during the second period, R3 is the net cash inflow during the third period and so on. Now, what is the decision rule? In case of standalone projects, accept a project only if its NPV is positive, rejects it if its NPV is negative, and stay indifferent between accepting or rejecting if NPV is 0. In case of mutually exclusive projects, that is competing projects, accept the project with higher NPV. Let's understand this important concept with examples. For even cash inflows, Swati Limited is evaluating the purchase of a new machine costing rupees 20 lakhs. The machine would be depreciated on a straight line basis over 6 years with rupees 2 lakh as salvage value. The machine is expected to increase sales by rupees 12 lakhs and operating cost not including depreciation by rupees 4 lakh annually. The firm's tax rate is 35% and it uses a 10% discount rate. Calculate net present value of the decision to purchase the machine. When we solve it, we will first calculate the depreciation by using the formula 20 lakh minus 2 lakh divided by 6 will give us rupees 3 lakh depreciation every year. The calculation of annual cash flow after tax by deducting the depreciation, we will get profit before tax as 5 lakh, then we will deduct tax 1,75,000, we will get profit after tax equal to 3,25,000, then we will add back the depreciation worth rupees 3 lakh and the cash flow after tax would be 6,25,000. In the last step, we would calculate the present value of annuity of rupees 6,25,000 for 1 to 6 years because the annuity is the same for the first 6 years, which will be multiplied by a table value 4.355 and it would give you 27,21,875. Present value of salvage at the end of 6th year will be multiplied by the 6th year factor, that is 0.564, and it would give you 1,12,800. Now, the present value of total inflow will be 28,34,675. Now, the decision making. Since the present value of cash inflows is greater than the initial investment, project has positive NPV and hence the project should be accepted. Now, to understand uneven cash inflows. Take an example, an initial investment of rupees 83,200 on plant and machinery is expected to generate cash inflows of rupees 34,110, rupees 40,700, rupees 58,240 and rupees 20,650 at the end of first, second, third and fourth year respectively. At the end of the fourth year, the machinery will be sold for rupees 9,000. Calculate the net present value of the investment if the discount rate is 18%. First, we will list out all the PV factors for the respective 1, 2, 3, 4 years. From the table, we can see how the net inflows have been calculated, how they are multiplied with the present value factors and the present value of cash flows is obtained. Then a total of PV cash inflows is obtained equivalent to rupees 1,08,877.299. From this, initial investment of 83,200 is deducted to obtain a net present value of 25,677.299. Net present value accounts for time value of money, and this makes it a more sound and strong approach than other investment appraisal techniques which do not discount future cash flows such as payback period and accounting rate of return. Net present value is even better than some other discounted cash flow techniques such as IRR. In situations where IRR and NPV give conflicting decisions, NPV decision should be preferred. But this method also suffers from some weaknesses. It is sensitive to changes in estimates for future cash flows, salvage value and the cost of capital. Net present value does not take into account the size of the project. For example, say project A requires initial investment of rupees 40 million to generate NPV of rupees 10 million, while a competing project B requires rupees 20 million investment to generate an NPV of 8 million. If we base our decision on NPV alone, we will prefer project A because it has higher NPV, but project B has generated more shareholders' wealth per rupee of initial investment. At the end, now let's summarize this session. Capital budgeting decisions are very important decisions as they are not easily reversible and involves huge expenditure. The techniques which are employed to evaluate them are categorized into discounting techniques and non-discounting techniques. The traditional techniques have certain limitations such as ignoring time value of money, ignores quality of benefits and not considering the benefits of the total project duration and so on. These drawbacks are overcome by NPV method and which is adjudged to be the best in capital budgeting evaluation. Thank you.